All right, welcome back, everyone. Today we're talking about something that's way less exciting than crypto and a little more important than most people realize: tax advantaged accounts. I know taxes aren't sexy, but understanding how to legally avoid paying more than you have to, that's one of the most powerful tools you can use to build wealth, especially when you're young. So, in this video, I'm going to break down what tax advantage accounts actually are, the different types: Roth IRAs, 401ks, HSAs, and more, and how they can help you retire earlier, invest more, and keep more of your money. First things first, what does tax advantaged even mean? Tax advantage account is any account that gives you a break on taxes, either now, later, or sometimes both. Think of it this way: the government actually wants you to save for retirement, healthcare, and education. So they created accounts that reward you for doing exactly that, by letting your money grow without being taxed the same way a normal savings or brokerage account would. There are two main types: tax deferred. You don't pay taxes now, but you will later. This is known as a traditional account. Tax free. Pay taxes up front, but your money grows and comes out tax free. This is known as a Roth account. Starting with the classic, the traditional 401k. This is the retirement account you usually get through work. Here's how it works: you contribute pre-tax dollars. Your money grows tax deferred, and you pay the taxes when you take it out in retirement. The big win here is the employer match. It's basically free money. If your company offers a match and you're not taking it, you're leaving money on the table. Also, in 2025, you can contribute up to $23,000 if you're under the age of 50. That's a massive opportunity to reduce your taxable income and stack up some long-term savings. All right, now let's talk about one of the most powerful and underrated accounts out there, the Roth 401k. Here's how it works: you contribute after tax dollars, your money grows tax-free, and when you retire, you can withdraw it, including the gains you've made on investment, without paying any taxes. You'll still get your employer match, but heads up, the matched portion from your employer goes into a traditional 401k, and that will be taxed later. If your employer offers a Roth 401k, strongly consider using it. I plan to max mine out starting next year because the long-term tax savings are game-changing. Now, the important thing to note here between the traditional and the Roth 401ks, and this will be the same with the IRAs as well when we get into that, but the reason you would want to use a Roth over a traditional is if you expect to earn more money in the future, because when you retire, the taxes taken out in retirement will be based off of the higher earning years that you had. So if you're earning less right now than you plan on earning, say in your 40s or 50s, then the Roth is probably going to be the one for you. Now, if you are going to be at a steady pace throughout your life with your income, maybe you're already at the top of your income level, in that case, the traditional would be preferred. All right, let's move on. Let's say you don't have access to a 401k, or you want to invest even more. That's where the IRAs come in, the individual retirement accounts. Starting off with a traditional IRA works just like a 401k, but you open up yourself and not with an employer. Contributions might be tax deductible depending on your income. The money grows tax deferred. You pay taxes when you withdraw in retirement. The current contribution limit is $7,000 a year if you're under the age of 50, so it's a great option to pair with your 401k if the 401k is already being maxed out. Now, this is one of my personal favorites, the Roth IRA, especially for anyone in their 20s or early 30s. You contribute after tax dollars, the money grows tax-free. You can withdraw everything, including growth, in retirement without paying a dime in taxes, same as the Roth 401k. Roth IRAs are perfect when you're lower in the tax bracket earlier in your career. If you start now and max it out consistently, you'll set yourself up for a seriously bright future. The only downside to a Roth IRA is that there is an income cutoff. However, there isn't one for a traditional IRA. So what you do is you max out the traditional IRA, then at the end of the year, you roll it over to your Roth IRA As long as the Roth IRA was made more than 5 years prior to the age of 59 and a half, you'd still take the money out tax-free. And here's a big tip for all the young people listening to this out there. If you have a job and you pay taxes, you can open a Roth IRA. There is no age limit on this. If you're 16 years old and you have your first tax-paying job, you should open a Roth IRA. You don't have to contribute much right now, but start with something. Even if it's the only $50 that you can throw at it, just do it. If the ball starts rolling now, by the time you're 50, you're going to be a millionaire. Just get it moving now. Maybe look up some information on what you should put the money into in that IRA. Listen to what I'm doing on this YouTube channel, or go talk to an actual financial advisor. All right, moving forward onto the HSA, the health savings account. If you have a high deductible health plan, the HSA is a triple win. Tax deductible contributions, tax-free growth, tax-free withdrawals for medical expenses specifically. No other account does all three. You can invest the money inside your HSA into the market just like an IRA. Once you hit 65, you can use it like a traditional IRA if needed. You'll just pay regular income tax on non-medical expenses only. Medical expenses still tax-free. All right, now we got the 529 plan, the education savings. Are you planning on having kids in the future? This is your go-to. You contribute after-tax dollars, similar to a Roth. It grows tax-free. Withdrawals are tax-free when used for qualified education expenses only. And now you can even roll some of it into a Roth IRA as well under certain conditions. Basically, if your kid doesn't end up using that money for educational expenses, you can take some of it and throw it into your Roth IRA to help max that out each year. So why should we all care about this? Taxes eat into your wealth more than almost anything else. Every dollar you can legally avoid paying in taxes is another dollar growing, compounding, and giving you financial freedom. Using these tax advantage accounts isn't just smart, it's strategic. It's the foundation of retiring early, building wealth, and creating options for yourself in the future. If you're not using tax advantage accounts yet, you need to start now. Even if it's just $50 a month into a Roth IRA or your 401k, that's momentum. Don't let confusion or fear stop you from taking action. You don't have to be perfect, you just have to start. Clearly, these accounts are very powerful. There is a reason why the government put caps on them. It's because it would make everyone way too rich otherwise. If you found this helpful, consider sticking around for more videos on building real wealth from the ground up. And remember, we're not chasing millions, we're building freedom. One decision today, 100 options tomorrow. Catch you in the next one.